Hi, let's cover my Elliott Wave scenarios on Bitcoin, starting with the bullish scenario on a daily time frame, where we're looking for a 5-wave impulsive structure and after wave 5 get a retracement. Now here we're looking for 3 to end and start a range in wave 4, and wave 4 is commonly a sideways corrective structure, more so when wave 2 is a sharp and deep corrective structure. So in a wave 4 we would now look for a flat structure in an ABC, or a more sideways WXY, or a triangle. Now, generally, a minimum target for wave 4 is the 0.236, currently sitting at 122.1k, taken from the low of 2 to the current high that we have. And the invalidation is the high of wave 1 at 118k, because wave 4 is not allowed to overlap with wave 1 in an impulse. Now you can see that price has now also touched the 1.618 trend-based subextension, taken from the start to the end of 1 to the end of 2, which commonly is a minimum target for a wave 3. And what is interesting inside this move to the upside is that when you observe the structure of this move to the upside, the largest candle is here in the middle at about 116k. But afterwards, you can see that the candles are slowly becoming smaller and smaller and smaller, while also price is curving more horizontal again. You can see basically that this structure moved to the upside with the biggest candle here. That is where it's most vertical. And now you can see that slowly price starts to curve horizontal again, while also volume is going down. Now, from an impulse perspective, inside wave 3, we of course look for an impulse as well, where we have a bunch of 1-2s here. We get to wave 3, and then we get a bunch of wave 4s and wave 5s. And once you move into wave 4s and 5s, you like to see a couple more highs on decreasing volume, and price is then also curving from vertical more horizontal. So it just shows that this wave 3 may have ended at a high or is going to end soon. And in this scenario, you're then looking for your wave 4. Now, if we then go to the more bearish scenario, where you expect a deeper retracement, but in the end, you're still looking for continuation, because this is a larger 3-wave flat, and then you look for price to move up afterwards. But here, you're just looking for a larger retracement in a wave C, as this is a flat and then a 3-wave A, ABC to the upside in a B, and then you're looking for wave C to the downside. Now, both the bullish and the bearish scenario are actually looking for the exact same thing. You're looking for this impulse to the upside here to end, and as explained also in previous content, we're looking for some 4-5s, and the probabilities are highest to eventually get that bigger range, for example in a 4, or get a retracement. But in both cases, you're looking for a retracement anyway. It's going to be either a retracement that starts the range of 4 or a deeper retracement in a wave C. But the directional bias between the two, this scenario and this scenario, is exactly the same. Probabilities are highest that an impulse here is ending, which means that you're either looking for a retracement which eventually turns sideways or a deeper structure. That is the directional bias that Elliott Waves gives you. I see so often, especially people that study Elliott Waves and are like in the middle of their journey where they're figuring out probabilities as well, they try to get stuck with one particular count, like this has to be it, right? This is the absolute highest probability and this is the alternative. But they basically miss the fact that in both the bull and the bear scenario they may have, you're actually trading it in the exact same way. The moment you're looking for wave 4s and wave 5s here, it becomes interesting from a general Elliott Wave trading point of view to take profits on the longs or potentially close the longs and look for short opportunities. And when there is a short opportunity according to your plan, you just wait for price to show more information, and based on the information that price is giving, you're looking for a 4 here or you're looking for a C. But this is just management because you're already positioned. So then based on the new information you get on the chart, you just manage accordingly. If the move that you eventually get after a 3 is a corrective structure to the downside, so for example you get a zigzag down to eventually create a larger flat, well then you know that, okay, we get a 3-wave structure to the downside, so therefore I'm looking for price to eventually take out the all-time high, and we're likely looking for a wave 4. So then from a take profit and management point of view, you're going to take profits at closer areas of support, and you're aiming for a 4, so you're probably going to close your trade before, of course, it reaches the invalidation, which would invalidate a wave 4. But if you get a 3-wave structure to the downside, you're likely looking for a wave of 4. While if price is moving to the downside in an impulse, 1, 2, 3, 4, 5, and then eventually you get a 3-wave corrective structure, potential for compounding, and then you get a large wave 3 to the downside, you're like, okay, cool, right? I'm looking now for wave C. We invalidated a wave 4. Interesting, looking for a 5-wave structure, and then 1, 2, 3, 4, 5, and after wave C eventually turns around. So now your take profit area is going to be the wave 4, wave 5 area over here of this impulse down. You get your wave 1, 2, 3, 4, 5. That is going to be the take profit zone. This is the entry zone, of course, as long as things are according to your plan. But you can see that from a trading point of view, it's actually quite similar because the directional bias is the same. You're looking for a retracement, which either turns in a larger range or a deeper retracement. And honestly, it does not matter if you get another 4 and another 5 to the upside, and only then you get that range or retracement, because the bias is the same. The bias is probabilities are highest. You're working here on the lower time frames on a bunch of wave 4s and 5s, which then eventually creates price to turn around, or eventually it stops the impulse to the upside and therefore price turns around in a bigger range or retracement. We'll see. Directional bias is the same. The management is going to be different. That's the biggest difference. Now, the target area for wave B is what you see on my chart. It's the blue box between 122.8 and 131.1K. If price is moving above the 131.1K level, slowly probabilities decrease for a B, but it's mainly this 1.618 and 135.2. If price moves up, touches this level, you are not looking for a larger sideways structure anymore. In the impulse scenario, your wave 5 here could easily move to, let's say, 135 and touch that 1.618 to invalidate that bearish scenario, right? But yeah, I mean, we just have to wait for more information. So these are the two scenarios that I keep an eye on the daily time frame. Then we get to the 1-hour time frame. And everything I just explained on the daily time frame with the management is exactly the same here, because now, of course, it's still the question, do we have a finished impulse? Do we maybe get one more wave 4 or 5? Because we're really getting towards the end of this structure to the upside here. You can also see here on the 1-hour time frame how price is climbing on decreasing amount of volume. Typical for your wave 4s and 5s. It is a typical impulsive structure as well. You get your bunch of 1-2s here. You get the 3 acceleration. You get your wave 4s and your wave 5s. This is the overlap area. This is the sharp structure to the upside. And this is another overlapping area. Also, like, it's basically OSO, which is something that we will teach in more detail in a completely free PDF that we are developing now. It's about 10 pages, which cover K-waves, which is basically Elliott waves, but extremely simplified, where you don't need to count, don't need to put the numbers and everything on your chart. But yeah, I'll share that when we're finished. It's probably going to be at the same time our book is going to launch, the Elliott Wave Compendium, which is all about detail. But we'll likely at that moment in time also launch the PDF, which basically covers such things in extreme simplicity. And it is so incredibly useful because in theory, what I just did earlier, I don't need to count this move. I don't need to have all of this mess on my chart. I can just look at the structure, look at the volume and be like, well, probabilities are highest, directional bias is highest to get a finished impulse at some time here and look for price to turn around. We have the 1-2s, we have the 3, we get the 4-5s, looking for a directional bias to the downside at some point to start a range or a larger retracement. But if we do look at the detail, we could have another 4-5. Right, where this move to the upside, I gotta say, this move on the lower time frames is incredibly messy. And I was considering a short yesterday, as I was sharing in the elite group as well. I said, I have a little bit of resistance here. Could be interesting for a short. However, every time price was touching resistance here, we had bullish CVD divergences. Like, there was no stopping. So if I just zoom in here, this is the move to the upside, like that messy structure. Bullish CVD, more bullish CVD. Every time price rejected, there was just more and more bullish CVD till eventually the all-time high was taken. But a great example, like short opportunity example, is here. You take out the all-time high, the previous all-time high. Price then drops. And the moment it's dropping, you slowly start compounding bearish CVDs, bearish CVD, bearish CVD. Price continues, bullish ones invalidated, more bearish CVDs. That is interesting, right? For a potential short opportunity, which of course is here, right? So yeah, it's about patience, is knowing what you're looking for, but I wasn't too interested to short this move towards the upside, to say the least. Now, when we would cover a potential wave 4, sure, this move to the upside again, it's incredibly messy. Could there be a motive wave in here, like maybe some sort of an ending diagonal? I'm not too big of a fan of initially counting this as a potential wave 5, but the end of an impulse can also be a messy structure. So I am aware that, yeah, potentially that over here could be your 5, and you're now looking for that retracement to create a larger wave 4 or to create a larger retracement in a wave C. But it becomes more interesting now to observe the new price action. This wave 4, yeah, okay, maybe it's finished there, but also again, you could still have a larger flat in an ABC. So that's your A, this is a B with internally then a probably WXY double zigzag structure here to the upside. Looking at the beginning, this is very much a 3-wavy structure to the upside. You have a larger range in the middle, and then you get another like move up. So definitely the potential for a WXY, which then turns into a flat wave A, wave B. Look for a potential C to the downside here, which then is an impulse. So you get a couple 1-2s. You want to see acceleration, eventually a couple of wave 4-5s. Preferably move into an area of support that gives an opportunity and look for a bounce. And that bounce up might maybe take out the all-time high again, or we're looking for even larger corrective structures where this is only W, you're looking for X, and then you're looking for a wave Y, and then this is your wave 4, right? Or at least maybe even the beginning. But you could create that larger range that then starts with a potential flat. You then get your X, you then get your Y. You get a sideways structure for your wave 4. Bottom line, you're looking at that range slash retracement again. So yeah, maybe you get another wave 4-5. Maybe you have a finished impulse where 5 finished here or 5 finished here. Again, it's just details, guys. It really doesn't matter. It really doesn't matter because your directional bias is the same in basically all the stuff I'm saying. I just like to enjoy the detail and explain stuff in a bit more detail and provide some education and this and that. But if we want to keep it very simple, it's not about this is the highest one or this is the highest probability one. No, the general bias is we're likely looking at price moving into wave 4s and 5s, higher highs, lower volume. We can see the curvature on the chart as well. It's interesting to look for that larger range or look for that retracement and then manage accordingly. Wait for your plan to align with the price action, or actually wait for price action to align with your plan and then execute the moment your plan comes to fruition. The moment as long as price is not aligned with your plan, you do not execute. You don't have to be part of every move to the upside. I even shared this yesterday in Discord as well. I'll quickly find it for you guys because I was looking for a long, not yesterday actually, I was looking on Sunday here, Sunday to Monday, I was looking for a long, and this was my plan. So let me open this. This was my plan, which I actually shared in Elite, I think yesterday. But I was in a meeting with someone yesterday where I explained what I was looking for on Sunday, Monday. And basically this was my plan. Like, okay, looking maybe for an impulse down here, couple of wave 4-5s, or at least price slowing down, decreasing volume, longer ranges into the daily naked point of control at 122.90. Price did not give me this setup because it reversed to the upside. I even put a limit order here, but the next morning I woke up on Monday and price moved towards the upside, removed the limit order, no interest. As price was moving up here, at no moment in time was my plan for a new long respected. I had no opportunity here to long because it was not according to my plan, and I cannot be bothered trying to long without having a plan, or something doesn't stick to my plan. So I just remain patient. I'm like, okay, well, I have no interest. I just have no interest to long with this move to the upside. I had interest to short, but then I didn't see weakness because of the bullish CVD. So, Now currently here on a 15-minute time frame, price is moving to the downside, and it is commonly easier for people to analyze a structure, like it's more easier to analyze motive waves compared to corrective waves. So we have a high here, and now it's interesting to analyze this move to the downside. Is it motive or is it corrective? Well, that's the question. Now it's easier to analyze this structure according to motive waves, like an impulse. Could this move down be an impulse? 1, 2, 3, 4, 5. Can this be a multi 1, 2? Can this be a diagonal? If you cannot count any of these three with high probabilities, you're likely looking for a corrective structure, which means you're likely looking for the high. That is going to be your directional bias again. So here on the chart, you can see that price is moving down. I did not count this at the moment in great detail because it's not important. Can we count an impulse to the down here? No. Why? Because too much overlap. You're not allowed to have overlap between a wave 1 and 4. There is too much overlap. You would need a larger move to the downside to consider an impulse. So, okay, this one is removed. Now then we get to a multi 1, 2. Bunch of 1, 2s, overlap, acceleration in a wave 3. You want to see wave 3, volume increases, and then eventually what you're looking for, 1, 2s, you get to 3, you get to 4, 5s, and then you look for price to turn around. Even better if these 4, 5s are like clearly decreasing in volume, you get a couple more lows on an area of support, great area of interest, look for a bounce, potential long setup right there. Now at the moment, there is not yet a clear reason to not consider a multi 1, 2. Like it's still possible. At the moment, price is just moving down. Sure, it's messy here, but price is moving down here, and we have to be aware of the potential of a multi 1, 2. But the moment price moves above this high at 124.7, multi 1, 2 is invalidated. Probabilities immediately increase to at some point take out the all-time high again. Now that can of course mean you just get a larger range and move up afterwards, but the directional bias is switching to the upside because then it becomes interesting to look for that high to be taken. Now you can also see, and I'll explain the reason why, you can see the 1.618 here on my chart. This 1.618 is taken from this low to this high. And what I'm going to explain now is what we call in K-waves, in basically very simplified stuff, it's K16 principle, like the Kuhn 1.616 principle, where we take a fib from this low to this high, which is the most recent range before this drop. Price drops to the downside, touches the 1.618, which means that if price would move back up, we are not counting this low here as a wave B or a wave X. That is very low probabilities. So, therefore, it's more likely this is a separate structure. It's not a B or an X. It's not that we are looking here for a larger A, B, and C or W, X, Y, because X or B is so deep. Low probabilities. So therefore, if price touches the 1.618 here and it moves to the upside and takes out this high, we're likely looking here at a corrective structure, not a multi 1, 2 anymore. In a multi 1, 2, you don't want to change the structure. So the 1.618 touched. If price moves back up, change the structure above this range, probability is higher to take the high. Boom. Done. Now, one could consider a diagonal. And if so, I want you to know that a leading diagonal is always lower probabilities than either a multi 1, 2 or a corrective structure. So it's always going to be an alternative unless, right, based on new information as price moves up, you're gonna like if you get a potential diagonal, like on Ethereum, there was a potential diagonal, I think last week or 2 weeks ago. If the move up then clearly shows a corrective structure, cool, there is the potential for diagonal correction and another leg down. But initially, a leading diagonal that starts something new is low probabilities compared to multi 1, 2 or a corrective structure. So if price would move to the upside, like imagine this here didn't happen, you touch the 1.618, that's fine, and price moves up, there is maybe the potential here to count some sort of a diagonal-ish whatever structure there, right? But initially, that is going to be a lower probability scenario compared to counting this correctively, meaning take out the high, especially price takes out these highs over here. Probabilities are higher after the multi 1, 2 is then invalidated here. Probabilities are higher that this is corrective compared to this being a diagonal, unless proven otherwise with whatever is happening over here. But that is what the probabilities are going to be initially, right? However, price now moved down, touched the 1-to-1 over here. If you want to consider a 1, 2, 3, 4, a 5-wave diagonal structure, your wave 5 is now longer than your wave 3, which is not what we like to see, and that invalidates a contracting diagonal. So at the moment, that is not very relevant. And then the same thing, if price can turn around and move above the green line, then we're looking for the highs to be taken because of the directional bias. So, it's two clear things. If we are going to get a multi 1, 2, 3 down, wait for the 4s and the 5s into an area of support, look for a bounce. If price can move towards the upside here and also then end this move down on a little bit here of increasing volume, price moves above the green line, bias is going to be take out the high. You probably are going to get a little bit of a larger range. So there's always the potential for long opportunities at a later stage. That is just local time frame stuff, but at least I wanted to teach that a little bit. Like the K16 principle is incredibly interesting, which is also part of the 10-page free file that we are developing for everyone. So, and there's more methods and principles and little tips and tricks and neat things in there to help you identify the directional bias, because bottom line, that is what we want. We want to have a directional bias and then trade according to our directional bias. So on the 4-hour time frame doesn't matter, but these are the volume levels that I have on my chart. So areas of support and resistance. Volume levels are my favorite levels, and these are the time frame horizontals. So you can see basically all the time frame horizontals at the moment are here at the bottom. If price, however, closes red today, we will get a daily here at about 124.7K. And then we have the order blocks. Can also be areas of support, of course. We have a 12-hour order block here on the 12-hour time frame, which is the first order block between 120.4 and 120.7K. And on the 12-hour, this is what it looks like. So you can see price is moving up impulsively, one red candle, and then it continues pushing, and it doesn't come back to this level, right? That's the difference as well with what you see here. One red candle, but then price moves up, comes back down. So arguably this wick already tested the order block. It's not interesting. This one, still interesting. Cool. Then we get to the probabilities. Just a quick summary here on the weekly time frame, not covered in this video, but covered in many previous videos. We're still looking for bullish outcomes and higher prices to come at a later stage. Number 2 spot, lower probabilities, bearish. On the 4-hour time frame, we expect a retracement or a range to come. Wave 4, wave C. We'll see what we get. Directional bias is the same on the 1 hour. And on the 50-minute time frame, as explained, if you can take 124.7K without at least finishing an impulse, because of course on the 15-minute, if you do finish your 1, 2, 3 and your wave 4s and 5s, this level 124.7 doesn't matter anymore. You really want price to turn around before you form the wave 4s and the wave 5s, move above 124.7. That is when probabilities increase to take out that high. So currently still with the price action we have locally, can you take 124.7? Okay, directional bias is going to move towards the upside. It's like we still expect price to take out this high. You can still get a larger range. That is no problem. It's just that your directional bias is going to be, well, probabilities are higher to sooner or later take out that high. It might be soon, it might be later, but your bias is the same. If you get an impulse to the downside on the 15-minute time frame, your 1, 2s, 3 and your 4, 5s, wait for the wave 4s and 5s, preferably in an area of support, decreasing volume, couple more lows, then aim for price to move back towards the upside and create a very nice tradable bounce. That being said, I hope this video was helpful or valuable to you. On the left, you can see a video on the simplest way to use and trade Elliott waves without even counting, and that is basically the K-Waves methodology. And on the right is the Elliott Wave educational playlist to help you understand more about Elliott Wave. Thanks for watching and subscribing. I hope to see you at the next one. Bye-bye.